Yes. So, so hi everyone. Good evening. Welcome to a new session of Jargon, the webinar series. So, this session is actually in continuation to our last session. So, I don't know, how many of you have joined the previous session, but uh, still, I mean, in the interest of time, I wouldn't be able to go much into the basics of financial modeling. So, this is more going to be a live session wherein I'll be taking you through an Excel spreadsheet wherein uh, we'll discuss about, or I'll take you through how a financial model, a simple financial model would look like. This is not a complex thing. I'll just share a very simple financial model and how the sheet is built and what changes, how it is reflected in the balance sheet, P&L and everything. Okay. So I'm sharing my screen. I hope my screen is visible.
No.
Okay. So basically, like I've told in the,
it's not visible.
I think it's visible for others, Ajish.
Yes, it's visible for us.
Okay. Now it's good. Yeah.
So basically, like I've told in the previous session. So here, I've just created 5 sheets here in this financial model. It's a very simple thing. So like I've told in the previous session. So firstly, we have a something called the revenue and the major cost assumption. Then something for the manpower thing. Then a P&L, balance sheet, and cash flow. Okay. So like I've said in the previous session, a revenue is typically driven by something. Okay. For example, if you're into consulting business, it's the number of clients that drives the revenue. If you're into product business, the number of users would be the thing that drives the revenue. Or if you're into a manufacturing industry or a trading industry, the number of units sold would be the revenue driving factor for creating a financial projection and model. So similarly, currently for this case, I've taken the example of a service entity. So I'll try to explain what these things are and all those things. Okay. So if you look at the key assumption sheet, so like I've told, so this is the input sheet, the primary input sheet in a financial model. So whatever changes you make or whatever input you give in this sheet, this will get automatically reflected in the other sheets. Okay, and in that manner, the financial uh, projection gets updated. So if you want to increase the revenue or decrease the revenue, increase the manpower, decrease the manpower, all those things you can do in this sheet. So this is the sheet where you can actually play around with the numbers. Okay, and in the other sheets you can see when you make these changes how it is reflected in the uh, financial P&L, balance sheet, and cash flow and everything. Okay, so like I've said here, we have something called number of clients. So this is service industry. So here I've considered the number of clients as the revenue driver. So if you look, I have created a revenue assumption sheet. So here we have number of clients in each financial year. So typically when we do a financial model, we do it in a 60-month period. We have a month by month kind of thing. But here for easier understanding and since we cannot go that deeper into the financial modeling thing, I've done it a year-wise model. Okay. So in the first year we have kept 15, second year 22, third year 30, then 38 and 45. Okay. Also the average revenue per client I've assumed as 12 lakh, 13.5 lakh, 14.5 lakh, 15.5 lakh and 16 lakh. Okay. So also I've considered the revenue growth rate also here. So this is nothing but your number of clients into average revenue is your revenue. So at what rate it is growing year on year. So ideally, so if you see the revenue growth is in a decreasing trend. Okay, so typically, people ask me whether is it logical to have the revenue growth in decreasing numbers. Okay, so basically the idea is for it to look more realistic, it should always be in decreasing trend, or maybe if you can increase it for a while and then it should decrease. Why? Because see, it's the same logic what we use for example, if one increases to two, it's like one increasing. Okay, so it's 1 plus 1 that becomes 2. But what is the percentage of growth? It is 100% growth. Then when 2 becomes 3, how much does it increase? It again increases by what? But the percentage increases 50%. So that is the same logic. So even in your business, the percentage of revenue growth may like kind of decrease. Why? Because even the absolute value would be increasing. The difference between the revenue that you have generated for this year versus last year, what is the growth in revenue? That delta, that would be increasing, but the percentage may decrease in that case because the denominator is also increasing. So that's the basic assumption, what or basic logic that everyone should have. But if you keep on increasing the revenue by 100%, 200%, 300% year on year, that means that in the fifth year you will be reaching at somewhere around say 1,000 crore or 2,000 crore, which may not be believable for an investor. Okay, so those things are factors which you have to take a call and decide. Okay, then we have COGS. COGS is cost of goods sold. So what is the direct cost? Okay, so here maybe in the consulting industry it would be the maybe some sort of tool we are using, for example, that could be the COGS. So here I have again kept an assumption of 35%, 33%, 30%, 28%, and 27%. The COGS would automatically decreases because there is something called economics of scale. So when we start doing more volume and more revenue, the associated cost should ideally decrease. Okay, so that is the logic. Then we have selling, general and administrative expenses, which I have taken again as a percentage of the revenue, which again decreases like from 2018, 16, 15 to 14. Then depreciation rate I have taken 15% standard on all the asset. Then tax I have taken 25%. Then we have few assumptions for the balance sheet. So receivable days 45 days. So 45 days means that if you invoice a client today, you will be getting the collection only on the 45th day. Okay. So when we do a P&L, typically the assumption is that your 1 year revenue into 45 divided by 365 would be your debtors at the end of the financial year. So that receivable days also have kept in a decreasing trend because at scale you will have more control over your debtors and you can negotiate better terms with the debtors, with the clients. Okay. Then payable dates, again from 30 to 35, it's increasing. The same logic. When you become a brand and when you become a trusted partner, automatically the credit that you're getting, that also will increase. For example, if you're paying somebody within 30 days now, with any years work, like enough, they'll be having more trust with you. So they'll give you 45 days credit. Okay. Then capex, like I've kept 25 lakh, 30 lakh, 40 lakh, and an increasing trend, like maybe like we'll have to add something, so that I've kept. Then I've kept a loan in this financial model, so that interest I have taken as 10%. Then interest expense I have taken 5 lakh, 45 lakh. So this is this I have considered as 50 lakh debt. So 10% is coming as 5 lakh. Then there is a repayment happening. So that is an assumption what I've taken here. Then share capital 50 lakhs. So 50 lakhs is the amount that the investor would be bringing in, or the founders would be bringing in year one. Then debt I have taken like 50 lakhs. 5 lakh would be repaid. 5 lakh repayment each year. Then other current liabilities I have another again assumed as 3 lakh, 4 lakh, 5 lakh, 6 lakh, 7 lakh. Again, this can also be linked to your balance sheet and all those things. Then opening cash balance I've kept 0, assuming that this is a newly started business. So these are the key assumption sheets. I hope this is clear with everyone. So I'll just move to the manpower sheet again. So now we have the manpower sheet. So here if you see, what I've kept is I've kept different designations here. So founder, engineering, sales and marketing, operations, finance and admin. So I've kept the headcount also here, 28342. What is the average salary per person? So for founders, it is 12 lakh per annum. For engineering tech, it's for, see, these are random numbers. Okay. So finance and admin, it's 2.7. So the total cost is nothing but headcount into pay per person. Okay. So that way we get 24 lakh, 36 lakh, 10.5, 12 lakh, 5.4. So total come to 87.9. So here we have 19 headcount. Here in the next year, we increase the engineering team. So year by year, I have kept a thing here. Okay, for 5 years, I've kept an assumption here. Okay, so I think that is also clear. Now we'll go to the P&L sheet. Okay. So now if you go to the P&L sheet, so now if you can see, if you look at here, This is the formula bar. So this revenue is coming from the key assumption sheets, that assumption sheet. So what is revenue? Revenue is nothing but average revenue per client into number of clients. So it's assumptions B7 into B8. So let us see what is B7 and B8. See, B7 is number of clients and revenue is 12 lakh. So that's the way it is coming as 1.8 crore. Okay. Similarly, like we have 297 coming, 4.35 coming, 5.89 coming, and 7.2 crore coming. So this is driven from the assumption sheet. So if you look at this sheet, I haven't entered any number as a hard-coded number. So everything is coming from where? The key assumption sheet. Okay. I hope it is clear. So again, if you look at the cost of goods sold, again, this is also linked to assumption sheet. Okay. So it is nothing but B5 into B12. B5 is this one, 180 into B12 of assumption sheet. So assumption sheet B12 is what? COGS percentage, 35%. Okay. So that way we are having 63 lakhs expense, then 98 lakh, 1.3 crore, like that. And then we have the gross profit. So gross profit is nothing but 180 minus 63. So if you look at the formula there, it's going to be B5 minus B8. So we have the gross margin also here. So that is nothing but gross profit divided by revenue. Okay. Then we have the employee cost. So employee cost is, if you see, it is linked to the manpower sheet. Manpower D12. So from here, if you see this is how 87.9 lakhs is coming. So if you remember, I've told this sheet. No? So basically it's 2 into 12, 8 into 4.5. Similarly, we take the total and this 87.9 is reflected in the P&L here. Okay. Similarly, in year 2, it's linked to year 2. Year 3, it's linked to, like that. I have linked it everywhere. Then selling general and administrative expenses, like I've told, it's again linked to the key assumption sheet. It's also a percentage of the revenue, which we have assumed so far. See, again, these assumptions are what I've taken for a simple standard session kind of thing. When we do a proper financial model, the assumptions would be more realistic. We try to make it more realistic. Even selling general and administrative expenses and all, we try to identify like kind of what is their selling means, how they are going to do the marketing. What is the like kind of, if we spend 1 lakh on digital marketing for every day, how much is the extra leads that we are going to get, and what is the conversion percentage that we are going to have, and what is the average revenue. So all these assumptions we'll have to take. So we'll have to make it more complex to make it more realistic. Okay, so this is just a very simple thing because I want you to understand how this thing typically work and what is the flow of that. So here, if you look selling general and administrative, it's again the percentage of revenue what we have taken. It's linked to the assumption sheet. Okay, so like that way we have total expenses 123.9. Okay, then the EBITDA comes in. So EBITDA is what? It's gross profit minus total operating expenses. So that comes to 6.9 lakhs negative. In the second year, it's 13.5 lakhs. So it keeps on increasing. Then we have the depreciation coming in. So depreciation, again, it's linked to the capex into percentage, what we have assumed in the first sheet. Okay. So that way depreciation is coming to 3.8, 8.3, 14.3, 19.5, and 24 lakhs. So if you look at the formula, it's again assumptions B14 into B20. B14 is depreciation rate. B20 is the capex. So that is the capex balance. Okay. Then we have EBIT. So in the earnings before interest and tax. So first thing, we have the earnings before interest, tax, depreciation, and amortization. That is EBITDA. Okay. First we had the gross profit, then we had the EBITDA, then we have EBIT. And after that, the interest expense is shown. So interest, again, we have taken assumption as 10% on the outstanding debt. And in the first sheet itself, I have shown the interest amount also. So if you see here, it is 5, 4.5, 4, 3.53. Okay. So that is linked to here. After that, we have what? PBT. Okay. So PBT is what? Profit before tax. Then we have tax expense of 25%. See, the first year, since the tax is zero, or sorry, the profit is negative or it's loss, we don't have any tax there. So that's why it's coming to zero there. Then we have the net profit, which is PAT, profit after tax. So that is coming to negative 15.7. Okay. So that's it about the P&L. If you have any queries, we can ask now.
In the first slide, you told that payable days 45 days.
Yeah.
So you calculated the revenue into 12 divided by the payable days. Could you please
No.
repeat that?
Revenue is nothing but average revenue per client into number of clients. So the payable days comes into the balance sheet. So that's for the what is the debtors, what is the receivable. So here, if you look, it's nothing but assumptions B7 into B8. So if you look at here, see this formula bar. Okay, it's B7 into B8. B7 is 15, B8 is 12. So it's 15 into 12. That's how revenue is coming. So that has nothing to do with the payable days or receivable days. So that is actually for the balance sheet.
When you pay, you told the calculation of interest.
Yeah. So that interest is for loan. So I have assumed a loan here.
Okay.
See, I have considered a loan here. This one, long-term debt.
Okay. So
Okay.
yeah. So in that P&L, first will be gross profit, then EBITDA, then
Then EBIT, then PBT, then PAT.
okay.
Yeah. Okay.
Yeah.
Yeah. Now we have the balance sheet. So balance sheet again, we have the gross fixed asset. Okay. So gross fixed asset is what? It's again the assumption what I've taken. So it's assumptions B20. So B20 is capex 25 lakhs. Okay. So in balance sheet, if you go, it's again 25 lakh. Then we have the depreciation. Depreciation is it's coming from the P&L now. So it's coming 3.8. See, it's assumption B14 into assumptions B20. So what is B14? It's depreciation rate 15%, capex 25 lakhs. So 25 into 15% depreciation is coming. So here in balance sheet, if you see, it's 25 lakh. Then depreciation of 3.8 lakhs coming in 15%. So the net asset value is 21.3 lakh. Okay. Similarly, in year 2, again, it's what is the B7 plus assumption C20. So B7 is what? The opening value of the asset, 25 lakh. Plus we have added a capex addition in the assumption sheet. So here if you go, we have added a capex addition. See, 30 lakhs. So 25 plus 30, 45, 55, 55 plus 40, 95, then 130 and 160. So that would be coming here. Then this accumulated depreciation would be the percentage, 15% on this number. Okay. So that way we'll have the net fixed assets also coming in here. Now here is the trade receivable, what I told Ajesh, if you remember. So it's considered as revenue. PLB5 is the overall revenue 180 into B18, assumptions B18 divided by 365. Assumptions B18 is receivable days. Okay. So which means that if you are doing 1.8 crores of revenue and you are giving a 45 days credit period to your customer, 22.2 lakhs of your invoices would be outstanding at the end of the financial year. Okay, so that is the assumption. So if you are keeping 45 days, it comes to 22.2. Similarly, every year, the next year would be linked to the next cell in the assumption sheet and the P&L sheet. So if you look, everything is kept like that. Then cash and bank balance I've considered as balancing figure here. Okay. So when I say balancing figure, the asset minus liability has to match always. So either you can do it as a balancing figure or you can derive it from the cash flow. That's up to you. But for your understanding, typically it's better. For easier doing, it's better to take it as a balancing figure. But make sure that your cash balance shown in the balance sheet and the cash flow is matching. Okay. So if you see here, I've kept minus 8.3 as a cash in the third year. So typically we should not be keeping negative figures in the cash balance. So that's the reason why I kept it there to pinpoint that thing. Typically it should not be there. Okay. Because in no instance the cash should be negative. Either you'll have to bring it as a loan or find some sort of investment and adjust it. So then we have the total current assets coming to what? Trade receivable plus cash and bank balance. So 71.3, 49.5. Similarly, so total assets would be coming to 92.5, which is 21.3 plus 71.3. So there is a decimal difference. That's why this 3 plus 3 is coming as 5 here. So there is some decimal calculation there. So we have for all years 92.5 and like that. Then we have the equity and liabilities coming towards the bottom. So share capital, like I've told in the assumption sheet, we have assumed it to be 50 lakhs. So if you see here, it's 50 lakhs. Okay. Then we have retained earnings, which is coming from the P&L. So retained earnings is something what comes from the P&L. So it's 15.7 lakh. Then it keeps on decreasing. Why? Or increasing. Why? Because retained earnings is always what is here, profit in the first year plus profit in the second year comes here. This is 1 plus 2. Then it's 1 plus 2 plus 3. Then it is 1 plus 2 plus 3 plus 4. Then 1 plus 2 plus 3 plus 4. See? So it's previous year plus this year profit, previous year plus this year profit. So like that. Okay. So total equity we have here, it's from share capital plus retained earnings. That is the total equity. Then we have assumed a long-term debt of 50 lakhs, which I just told earlier. See, this 50 lakhs is there. Then we have trade payables. This is again in line with how we have computed the receivables. So here we have considered a trade payables of 30 days, if you remember. Okay. So here what we have done is P&L B8 into assumptions P&L B8. What is B8? So it's the total cost of goods sold. So that amount into 30 divided by 365. So which means that if we are getting 30 days credit from our supplier, which means that at the end of the financial year, of the overall COGS of 63 lakhs, 5.2 lakhs would be payable. Okay, will be outstanding. Then other current liabilities I have assumed as random numbers, which we have already seen in the assumption sheet. If you see here, again, this can also be linked to some sort of formula and everything. Then we have the total current liabilities of 8.2, 12.6 like that. Then the total comes to 92.5, 92.5. See, every year it should be matching. So that also I have kept a check here. So asset plus liability should be matching. It should come to 0. Asset minus liability should come to 0 every year. Okay. If that is clear, I'll go to the cash flow. Does anyone have any question?
So if the trade receivable is something, that means we owe that much amount for a year.
No. Trade receivable is receivable for us. That's an asset. So we have sold to someone and they are yet to make us payment.
Okay.
Yeah. Trade
But
payable is the other way. Like we are yet to pay someone.
Okay. Thank you.
Yes. So now if you look at the cash flow, so cash flow is basically derived from the P&L. But if you remember, like in all my sessions, I tell that there is a lot of difference between P&L and cash flow. So now when we go through the P&L, we'll understand, to the cash flow, we'll understand what the difference is. So here we have taken net profit as the first element. So this is coming directly from the P&L, this line. 6th row is coming directly from the P&L. So if you look at here, it's coming from P&L. See, P&L B31. So 15.7.6. So these are the numbers what we see in the P&L. I'll just show that too. See, this is coming there. Then we add back few expenses. Why? Because depreciation. For example, depreciation. So in depreciation, like there is no real cash outflow. Depreciation is actually a charge on the asset, and that's a like kind of nominal. I mean, it's a notional expense. Okay, it's not a real cash outflow happening in the depreciation thing. So we add back the depreciation because that much cash we haven't given out of the business. So ideally, the meaning is that if we have done business and the profit is the remaining cash in our hand. So that is why we are taking P&L as the first element there. So we are assuming that 15.7 lakh negative should be our cash, but depreciation we haven't paid. So we are adding back that. Then interest expense we are adding back. Why? Because this is just a format thing that we will be deducting in the cash flow from financing activity. If you look at here, if you look at row number 23, I've adjusted that again here. So this is just I mean, what to say, reporting kind of cleanliness. So we don't show the interest expense in the operational cash flow from operations, it's shown in the cash flow from financing activities. So that's why I've added back that there. Then we have increase or decrease in receivables, which means that if the receivable increase, that means that uh, we don't have that much cash in our hand. Okay. So what we are assuming? We are assuming we have made a loss of minus 15.7 lakh. And if profit and loss equal to cash flow, that means that our cash should be minus 15.7. But in the 15, how is minus 15.7 coming? It's coming from 1.8 crore revenue. Of the 1.8 crore revenue, 22.2 lakhs is yet to be received. So that we should deduct from the cash flow. So that is how this 22.2 is deducted. Similarly, the net effect is deducted in all the years. Okay. Then increase or decrease in payables. The same logic we are applying it ulta. Nothing but like kind of we have assumed that 63 lakhs is the COGS, but of which 5.2 lakhs we haven't paid to the people. So that's outstanding. So that we have considered there. Then other current liabilities again. These are again another amount which we need to pay to people. So that also we are adding back. So the net cash flow from operation comes to minus 20.9, 5.8. It comes like this. Okay. Then we have cash from investing. When I say investing, it means anything related to asset. So if you remember in the assumption sheet and in the balance sheet, we have shown the capex addition. So in first year, we are investing 25 lakh, second year 30 lakhs, 40 lakhs, 35 lakh, 30 lakh, like that. So that is also shown as negative because we are paying this cash to someone. So this is cash going out of the business. So whatever negative you see in this sheet is cash going out of the business. Whatever positive you are seeing in the sheet is like kind of cash coming into the business. Okay. Now we have like kind of cash from financing. So here we have like kind of what the debt repayment or borrowing is there. Currently, like kind of there is. So ideally, sorry, I have missed out the debt and the equity part here. So ideally, like kind of we had a equity of 50 lakhs and debt of another 50 lakh. If you remember the assumption sheet, see we had 50 lakhs here. Okay. So that should have been also part of this cash flow. Why I am shown is like kind of since I've shown it already in the assumption sheet. Okay, so that was actually missing from my end. But so basically, it's like kind of you add these three: net cash flow from operations, net cash flow from investing, and net cash flow from financing. It's minus 50.9 lakhs. So 50.9 lakhs you have spent from your business. Cash has gone out of your business. But how much money has come into your business? You have invested 50 lakhs into the company. You have taken a loan of 50 lakhs. So 1 crore you have taken. So from that 1 crore, this 50.9 goes and your net balance becomes 49.1 lakh. Okay. Similarly, in the second year, you had 49.1. The sum total of these three is coming to minus 23.5. So you are having 15.4 lakhs here balance. This is deducted from 49.1 what you had in your hand. Okay. So that is how the cash flow is derived. So here I have shown that debt repayment also. So if you remember here, the assumption sheet we have shown from 50 lakh, it is going to 45 lakh, 40 lakh, 35 lakh, 30 lakh. So each year we are repaying back 5 lakh, 5 lakh. So that I have adjusted here. Okay. Yes. So that's it about the cash flow as well. So now if you have any questions, you can ask.
What is this interest in other CL mean in the working capital?
It's not interest, it's increase or decrease in other current liabilities.
Means like electricity bill, like that.
Yeah. Electricity bill, salary payable. So typically like kind of at the end of the financial year. So if you're paying salary on 1st of the month, say 1st of April, the salary outstanding on the salary which was due for 31st March would be outstanding.
Okay.
And if you're paying rent on say 5th of next month, the rent due on 31st March, it will be shown in your P&L, but you will be paying it actually in the next financial year only.
Okay. And how will I can say like this? This is a cash flow positive cash flow negative? How can I find it?
So it's basically from the net cash flow from net cash from operations. So if you look at row number 15, okay, so this row.
Hmm.
So if in the first year it's minus 20.9, it means that your cash flow is negative. In second year it's 5.8, it's cash flow positive, like that. I mean that's the basic thumb rule. Like, but the sum total of this three is the actual cash flow. But from an investor perspective or from a business perspective, actually the primary aim should be to make your cash flow from operations positive.
So anything which is in bracket, that means it is cash flow
Negative.
negative.
Yes, correct. Everything in bracket is negative numbers.
Okay. So if we see like something in this bracket, that means it is not a good sign. Correct?
See, it needn't be like that. It just means that it's a negative number. So it's on how we like kind of how we read it. So basically, in a cash flow, typically negative means cash going out of the business, but that doesn't mean that always it's not good. For example, if you see that capital expenditure of minus 25 lakh, okay, so that doesn't necessarily mean that it's a wrong thing or it's not good. Maybe like kind of for doing this business, you would be requiring that much level of asset. So it's not a bad decision to like spend 25 lakh on the asset.
But why should we put this capital expenditure in bracket?
So that's actually cash going out of your business.
Going
No? So
out.
if you
Okay.
so if you want to buy laptop, you have to pay to someone.
Okay. Okay.
Yeah.
And in that asset and liabilities, you included the cash in the bank also. Should
Yes,
we
yes,
have
yes.
to?
Yes,
Should
yes.
we?
In the asset, the cash in the bank will also be included. So this is cash in bank and bank. So when we say cash in finance, it's typically cash plus bank. For ease of saying, we say like kind of cash.
Okay. Okay. And if the interest expense in the eighth line is 5 lakh, the same should be in the cash debt repayment. These two amounts should be same, correct?
Yes, yes, correct, correct, correct.
Okay. Because okay, in that for the eighth line it is not in bracket, but in the 23rd line it is in bracket because
So
we.
that's just because I'm just doing an adjustment. See, if it's actually derived from the profit, no. So that's why I first added back that interest in the eighth line, then I have subtracted it in the 23rd line. So that's just a, like I have told, it's just a reporting cleanliness. So we don't show the interest expense in the cash flow from operation. The interest expense should be in the cash flow from financing. That's why I've just added it there and deducted it in the bottom. Yeah. Okay. So basically, yeah. So that's it from my end. So if you see, like again, it's a continuation to what I've told in the previous session. So we have an assumption sheet where we do mark all the assumption, like how the revenue is driven, how the expenses are driven, and all those things. Then we have a manpower sheet, like what is the number of employees, what is the headcount, what is the designation, what is the salary, and all those things. From which we derive the P&L. From P&L, the balance sheet is derived. Not everything is from the P&L. Few things from the P&L and few things from the assumption sheet. Then we have the cash flow, which typically is derived from the P&L and balance sheet. Okay. Yeah. So that's it from my end. If you have any other questions, I'll take it, or we'll end the session.
Actually, if we, how can like if I want to say like this company is a good, suppose I'm investing in the stock market, some stock. So in P&L, they might show a very high profit, but we have to look in conjunction with the cash
Cash
flow.
flow. Yeah, correct.
So is there any red flag kind of thing? If that.
So if the like kind of P&L versus cash flow, there is a huge gap, that could be a negative sign. I mean, if when I say cash flow from operations, okay, because see, there could be one another thing. For example, the profit is 10 lakh rupees, but the cash flow is negative 5 lakh. The main reason for that is they have purchased an asset of 20 lakh. There you cannot tell that there is a huge gap between the P&L and cash flow, so this company doesn't look good. You cannot tell like that. So that's again, like you'll have to evaluate the reason. You'll have to go through the cash flow and understand why it is spending. For example, if you have done 1 crore of revenue and 75 lakh is outstanding with the debtors, that means that there could be a chance of fraud. We have seen like that in many of the startup cases also. They have done bogus invoices and like kind of what there are no actual customers, or they haven't sold anything properly. So those things can also happen.
I have 2 more questions I will ask.
Yeah, Shailaja, maybe you can. Hello. Shailaja, for some reason we are not able to hear you.
Hello.
Yeah, Irshad. Hi.
Okay, how the key assumptions in the financial projection are you selected? Like the determination of the selecting the assumptions.
See, again, like I've told, this is just what I've done for a session. So typically, when we actually do a financial model in real scenario, we sit
Okay.
with the founders, try to understand how their business model works. Maybe like kind of if it's a manufacturing company, there could be a product mix. Maybe like kind of you apply X percentage of this product or X gram of this product and Y gram of this product, we'll be getting the output of Z gram of this product. So there will be few things like that, which is peculiar to that sort of business. So that is something like kind of we'll have to leave to the founder's judgment. But again, it should align with the industry standard, and it should be like kind of believable. You cannot simply say that if I start a business today. So, for example, if we start a business, we cannot tell that the revenue will go from 0 to 1,000 crores in first year. So that sort of assumptions we cannot take. So it should be realistic, and it should be like kind of depends on business to business. Yeah, and some assumptions may work for Irshad's business, but it may not work for Ajay's business. So those are the things, and the way in which you do the business differs. So there is a lot of human element also involved in the assumptions. You cannot simply take some random assumptions. It should be in line with the industry standard. It should be believable. It should be realistic. But yeah, it changes from industry to industry. It changes from founders to founder. Yeah.
Okay.
Yes.
So
Yeah,
always
Shailaja, you can ask.
ensure.
Yeah.
Okay. So always ensure that the assumptions are like the industry standard, right?
Yes, I would say yes.
Okay.
Mr. Abhijit, I wanted to know about the free cash flow post the investing cash flow being adjusted to the operating cash flow. So how does it help any business?
I mean, so
How
free cash flow. See, free cash flow is basically like kind of what your disposable income, or like the amount that you can spend freely. So if you have a lot of free cash flow, that means that your business is well and good. You are going to have infinite runway. That's the main thing. I mean, free cash flow is the strength of the business. Like people say, P&L is more of a kind of P&L is not actually real. It's more of a kind of an opinion, or like kind of judgment what we make on the business. But cash is something what is actually the factual kind of thing. So free cash flow is, if you're having good free cash flow, that's the like kind of best thing that you can have in a business.
Okay. And how do we use it? I mean, to present our about our financials to maybe other businesses, or how do we in other negotiations? Where does it become very significant?
So it becomes it's significant not only in investor presentations or anything. It's also significant from a founder standpoint also. See, primarily, when you do a financial projection or financial modeling, uh, see, investors come in second. Firstly, it's the founder who have to have that level of conviction about their business. Primarily, it's like kind of you are judging how your business, or you are like kind of predicting the future of the business given these are going to be the conditions. So primarily, it's for you to understand whether by doing this business in this method, whether I'll be able to make free cash flow, whether I'll be having enough of cash surplus in my bank account. So primarily, it's for you. Then only like kind of it comes to convincing to the investors or anyone. And see, wherever it is, see, to have free cash flow, it's a good thing. It's the best thing that you can have. And again, like kind of when you do this sort of financial modeling and projection, make it believable, make it realistic. That's the thing.
Thank you. Thank you.
Anyone else?
Yeah. Actually, can you please explain again that how you calculated trade receivable and trade payable?
So trade receivable, I have kept in like kind of number of outstanding days as 45 days. So the simple formula is that
Okay.
if you're doing 1 crore revenue or say 1.8 crore revenue in the full financial year,
Okay.
45 last 40. So just imagine. So when we do it in Excel, what we can assume is that the sale is happening evenly across your financial year. So this 1.8 crore is nothing but your daily sale is divided by 360 or 365. Okay, let's assume that that's the ideal situation, which means that if you have 45 days of trade receivable there, all your invoices from February 13 or 14 is pending till March 31st. Okay, which means that
Okay.
45 days of your revenue, which means that 1.8 into 45 divided by 365 is going to be outstanding.
Okay.
Okay, so that is the way in which this trade receivable has been calculated. Same is the logic for trade payables also. So for example, if you are having 63 lakhs expense in the year, we are assuming that this happens evenly across each and every day, which may not be realistic. Okay, again, that I have to say, but we are assuming that this happens evenly across the day, and in that way, all the expenses from March 1 to March 31st is still to be paid. So
Yeah.
it's payables into, I mean, the COGS into number of payable days divided by 365. But if you're doing a monthly kind of thing, if you're doing a monthly P&L and everything, maybe like if you can make it more realistic. So this is a very simple like a financial model what I've done. That's why I've taken assumptions like that.
Okay. Got it.
Yeah. Okay. Yeah. So Ajish, if you can ask your last
Yeah.
two questions in one shot, yeah.
Yeah. In this in the cash flow, how will we know like free cash flow is there?
So free cash flow is the total net change in cash. Like if you see the this one in the end, no.
Oh.
So this one, row number 26. So that's the free cash flow. So in first year you don't have free cash flow. You have 50 point something 50.9 lakhs going out of your business. Second year it's 23.7. In the first 3 years you don't have free cash flow. The fourth year you have free cash flow of 30.6 crore coming in, and in the fifth year you have a free cash flow 74.5.
Okay. Okay. And is there any way like we can calculate we can come to know the contribution margin and see the break even and all in the financial model?
Yeah, see, everything is basically derived from the Excel sheet what we have created. So if you want, you can add the break-even analysis here. If you want, all those things can be done. That's not a challenge. Maybe to make it simple, I haven't added the break-even analysis, sensitivity analysis, and all those things here.
Okay. And in the P&L, in the first year it was profit and loss sheet. The first year it was in negative, then it increased. Am I
Yeah,
correct?
correct.
Okay. Okay. And can we also calculate what is the profit every month?
See, ideally, that's the way it should be calculated. So when we do a complex financial model or a financial model for the investor outreach or for any business, we do it on a monthly basis. Since this is for an education purpose, I have done it on a yearly basis.
Yeah.
We typically do it in very detailed manner. This is not the kind of sheets what we create. So there are going to be multiple sheets, and there is going to be every minute level of detail in the typical financial model that we build for our clients. Since this is just for education purpose, I have given a snapshot and like kind of I've given an overview, because it won't be practically possible for me also to take you through entire sheets in 1 hour session, and it will be very complex also. And like I've told, it also depends on the business that you're doing. So if I take it for a manufacturing concern or for a SaaS product or something like that, the problem is that if people are there from other industry, they may not understand that. So when I go that level of detail, it becomes a very focused session. That's what.
Can we download any like financial model for some real estate company like that and all, like a hotel like that? Can we get
I mean,
samples?
we can get samples. See, actually, I'm actually trying to build something in my company's website, so where you can download these templates. So currently, I have built a couple of samples. I've built one for a SaaS company and one for a D2C brand. Maybe like if I'll help you build something for a hotel and real estate kind of thing, and you can download it from there. So
Okay.
once I'm done, I'll put it in the WhatsApp group.
Yeah. Thank you. Thank you.
Yeah.
Very
Thank you, Rajesh. Yeah. So Harinand, you can ask a question.
Hi, Abhijit. Actually,
Yeah,
I'm attending your class for the first time, so I mean, it's really helpful, like attending all these classes, and also I'm hoping, like, I mean, in future, like more detailed financial modeling things will be there. I just have one doubt here. I mean, out of concern, like cell B30, is that hard coded number?
Cell B30. No, it's coming from the balance sheet.
Okay, it's coming from balance sheet. Okay, ideally, like, I mean, that since that equity and debt thing is not here, so I was just thinking whether that is
No,
hard-coded or.
it is from the balance sheet.
Yeah.
So yeah.
Okay, fine. Thank you so much. Bye.
I'll share this Excel with every participant.
Okay.
Okay. So if that's it, like we'll yeah, Omkar.
If companies' reserves are increasing, that that means company is doing good in cash flow. Is this my thinking is correct?
I mean, see, broadly, yes. But every time it doesn't mean that the company could be doing operationally good, because in reserves, what you can have is if you are raising any investment from any investor. So if you are raising it at a high valuation, a lot of amount would be going to the reserves as well. But broadly, yes, when the reserves increases, it means that the companies the company is making profit, then that profit is getting accumulated, but that doesn't imply that your cash is getting accumulated. So that's one thing what I want to clear. So for example, if you look here in this balance sheet, see the reserves is the what retained earnings. So this is the sum total of the overall P&L what you have done across 5 years. But that doesn't mean that your cash flow is that much, because you are purchasing assets also, or you are repaying your loans. So that cash will be going out, which won't be affected in your retained earnings or reserves and surplus.
What
Okay,
is
got
the disadvantages of cash flow loans? If you could just.
I mean, see, I wouldn't say there is any disadvantage in loan. See, it's all about like how you manage the finance of your company. So if you're having too much loan and you don't have enough of profit to repay the interest and principal of that loan, that is the concern. But apart from that, there is no negative thing in like having loans in your balance sheet or PN. I would ideally say it's a good thing, because why you're getting loan is because the bank has evaluated your financials and given you a loan. So that's actually a good thing to have. So it's like somebody like if a bank is validating your business. So it's actually a good thing. But when you have default and when you don't have enough of profit or cash balance to like repay the loan in next 5 to 7 years, which the tenure actually is, that's going to be a problem.
Okay, thank you.
In any business, like somebody told me, when you have to pay somebody, delay it as much as possible. When you have to get some money, get it fast. Is it true?
I mean, see, that's the usual thing. It's basically like if you invoice somebody, it's better you get the money today. And if you want to make any payment today, it's better to defer it tomorrow or day after. But if you're having good cash flow and if your clients are paying you on time, then there is no reason to like kind of delay the payments that you have to make to your vendors. Why people typically say that is because to manage your cash flow. So if you get your collection today and you have to pay only after the 10th day, that means that this amount you can maybe invest in your working capital, or like kind of maybe you can buy more raw materials for your business so that you may get another 1 month of extra revenue. So those things can be managed.
Like if you can use that money for 10 days. Am I
Yeah,
correct?
correct.
If there is any viable way to use it, it is
Yes.
good.
Correct.
Okay. Thank you.
Okay, so it's almost 7:30 now, so I'll not take any more questions today. So thank you everyone. Thank you for joining the session. So we'll keep you updated about the upcoming sessions in our WhatsApp group and all our social media handles. So thank you. Bye. Good night.